Good evening, everyone. My name is David Zeffman. I'm a partner here at Oldswell. We're delighted to welcome you here and to be hosting this event. Actually, I think when we agreed to host it, I don't think we knew what tonight's topic would be. It's actually a very appropriate one for us because we started the firm about 30 years ago. At that time, we were 3 lawyers concentrating on film and TV, production, finance and distribution. 30 years later, we are very much a mid-sized firm. We are about 700 people, 350 to 400 lawyers, now based here in London, in Reading, Paris, Brussels, Berlin, Madrid, and shortly Singapore. So big success for mid-sized firms is very much something that plays to us and which we would like to apply to us. I'm going to hand over to Matt, who will introduce you to the panelists, and I hope you have a very good evening. Thank you.
Thank you, David. On my part, I should welcome you all here and say thank you very much for coming. First of all, to say that I'm clearly not Neil O'Brien. Hopefully that's a positive thing, or at least neutral. I'm Matt Oakley. I head up Policy Exchange's work on the economy and social policy, so 2 pretty big areas, and it's a real pleasure to have you all here for what's the first of a series of events we're holding on growth over the next 9 months or so. Firstly, I'd like to thank David and Oldswang for hosting us tonight. I think everyone would agree that this is much nicer than Policy Exchange. Those who've been in the hot and sticky Policy Exchange with the sirens outside will probably appreciate the nice view around here more than Westminster. So thank you very much. Also, thanks to Barclays for kindly sponsoring us tonight and indeed speaking. Really appreciate it. I think kind of both partnerships kind of show our kind of desire to partner with people who are based in the city, are based where actual growth is happening, and that's kind of a key for us, is that we don't sit in Westminster and talk about stuff. We actually get out there and see what's going on the ground and try and get evidence from you guys. So this is a huge area for Policy Exchange, not just mid-caps, but growth in general. As I said, this is the first of around 15 events we're going to be hosting from the discussion today through to things like productivity, technology, exports, innovation, the tax system, a whole host of things we'll be hosting over the next kind of 9 months. And the purpose of this is to, as I said, try and get people in the same room talking together and try and get the ideas from the experts and the people on the ground to actually inform 2 publications we're going to be putting together. One before the autumn statement, which will be setting out a kind of a pathway that we think government should be following, and some areas where we think that policy should focus, and then another quite large document potentially before the budget, which actually gives the government some clear policy recommendations. So contributions greatly from the floor will be greatly kind of appreciated throughout the night to kind of get ideas flowing. So this is mid-caps, really interesting area. I think potentially underplayed the importance it has for the UK. So just a couple of stats, there's around 10,000 firms which peers are classing as mid-caps in the UK. That's between a turnover of between 25 million and 500 million. And they account for around 1/5 of total employment and turnover in the UK. So a huge contribution to the UK economy. But despite this huge contribution, they don't really seem to have received the attention that, say, the SMEs or the multinationals have received in the UK until now, until the BIS are doing the part of the growth review on it. And I think the other reason that this is interesting is because, unlike Oldswang, we've just heard, has grown from a small company into a thriving, growing mid-cap firm. I think what's often levelled at mid-cap firms is that actually they don't have that kind of growth ambition, and they don't have the growth potentially or the desire to grow that some smaller firms are often have. And so these are a couple of the areas I'd like to talk about. So what are the blockages to growth, and also what the role of the businesses themselves might be. But that said, I basically want to hand over to the people who I think are probably much more expert in this than I. So on my far right, your far left, we have Mark Prisk. Minister of State for Business and Enterprise, who will be speaking first. Right here, Dan Roberts, Managing Director of Barclays Corporate. And then my left, your right, John Longworth, Director General of the British Chamber of Commerce. And with that, I just want to hand over to Mark.
Thank you very much. I will stand up, just it's better for my digestion usually, hopefully for yours as well. Good evening and thank you very much. I'm delighted to be able to be here, and there's the usual health warning with ministers on an evening when there's a vote. I have to disappear out the door at 7:20, so if John is in full oration at this point, or you're asking your brilliant, well-honed 13-point question at that stage, I may have to disappear. Please don't take it personally. Government actually understands big business rather well, not surprisingly, as the structure and form is often rather similar. And naturally, all governments actively proselytise the case for small businesses. And we are very much doing that, and have been doing that for the last 16 months. But what about the people in between? And I was quite staggered when we entered into this arrangement of the second phase of our growth review, just how little has been done in this field of what we'll call mid-sized businesses by government. There have been occasional reviews and studies, but there hasn't actually been, as far as I understand it, in the last 20 or 30 years, a genuine cross-Whitehall assessment of this group of enterprises. Now, it is, of course, a broad group. In theory, 25 million to 500 million. That's a lot of sins in between there as such. So it describes a whole raft of different businesses in shape, character, governance, and so on. But nevertheless, it is an important group. And I think John Cridland, when he talked about the sort of the hidden middle, as it were, was absolutely right to flag that up. And it was something that the Chancellor, Vince and myself and others wanted to respond to, is to make sure that whilst we've got a number of very active policies to assist us, the S in SMEs, what about that middle group? So this second growth review, which will have outcomes set out in the run-up to the autumn statement, has really tried to drill down principally into three areas. The issue of finance or investment, the question of exports, and the issue of management capability. And I think for the purposes of today, I'll just canter through those quickly, and then we can, fellow panelists will want to put out their views, and then we can get into discussions. What's interesting through the recession and now into recovery is noticing that actually many MSBs, if we can get into an acronym now, have actually been quite resilient. Primarily because they have quite substantial cash reserves and they're sitting on. A rational decision, you might think, at this moment. The problem, though, is that there's a reticence to do anything more from most of those MSBs than either borrow money from the bank or use cash reserves to grow. It's something we see across corporate Britain generally, I have to say. It's a similar issue in the small businesses of beyond credit cards, in their case, beyond credit cards, overdrafts and loans, what else is there financially? Whereas when you look at their comparators in Germany, America, Japan and elsewhere, there's a much more sophisticated range of access to finance and also of finance that is made available. So we have two problems. We have what is actually out in the marketplace and how much are MSBs actually thinking about accessing those different forms of finance, particularly on the equity side. Now this comes back in part to the character of an MSB, which on the whole tend to be, if not family owned, then certainly having quite a narrow share ownership. So one of the issues I think in finance terms is what do we need to be thinking about in terms of alternative finance options. Now in sectors like the automotive area, for example, we are really looking at the question of not only strengthening the supply chain, but considering whether there's an appropriate development of supply chain finance. I'd be interested to hear your views on that. I think also there's a debate to be had very strongly, and I think we're going to be discussing this in a moment, about whether in this country the corporate bond market actually could be much more sophisticated and broad, particularly for this group of enterprises. So I think the question in my mind around finance is both the range of finance that's available and the willingness of MSBs to access that and be more diverse in what they're doing. The second area that we've been looking at is the performance on exports. Considerable amount of management data now are showing that those businesses who export also tend to have a stronger performance record in their competitiveness and so on. I'm never totally convinced about whether there's an absolute direct cause and effect and whether actually they aren't two sides of the same character of a business when one is capable and exporting. But nevertheless, it's an important factor. And again, we see UK MSBs, by comparison, particularly, for example, to the Mittelstand in Germany, of actually not exporting either in the number or in the range of markets they're seeking to export to. There is a very conservative nature in MSB export performance by comparison to other competitors. And the question we're examining, and again we'd be interested to hear your views on, is why is that? What is that inherent caution about? Many would feel it's around the finance issues that underpin the ability to export and cash flow and so on. But I'd be interested to hear your views as people in the marketplace. And then the third aspect, I think, which is crucial, is management capability. There have been a number of surveys, but I think the most obvious one is the CPS McKinsey survey, which has been looking at UK, Japanese, German performance in this field, about the various management indices of capability, competitiveness, and so on. And I'm afraid to say that UK MSBs do lag behind. And the question is what that's about, whether there's an issue of governance, whether it's an issue of ambition, whether it's something else around the opportunity of having a very liquid market here in the City of London, which means that you grow it, you sell it, you move on. We would want to have a look at that. And I suppose the question in our mind is, why is it that capability seems to be behind? And what can government, and I use this word carefully, what can government usefully do to change that? And I come at this as someone who is generally sympathetic to the argument that Ronald Reagan once put out, which is that the 9 most dangerous words in the English language are, hello, I'm from the government, I'm here to help. So I have a caution about government wading in. Sometimes our job is to nurture changing culture, not to try to tell people what to do. So I think in all those 3 areas, in investment, in exports, and in management capability, we are trying in a series of meetings with stakeholders, to use the parlance, people who actually do own those businesses, to understand what's there and understand how we can strengthen their growth capability and make sure that actually as part of the wider economy, MSBs in this country are both recognised and actually supported in a way that allows them to fulfil their potential. So more than enough from me. Back to you, Chairman.
Thank you very much, Mark. Dan, Mark spoke quite a bit about one of the big issues being finance. Clearly you're hopefully in a position to talk a bit about that, so I'll hand over to you.
Okay, thanks. And for my digestion, I'll also stand and follow the pattern set by the Minister. After a long time in the twilight zone between SME and FTSE 250, or the large caps, I think it's absolutely fantastic. It's great to see a renewed level of interest in understanding the issues faced by mid-sized firms in the UK. And we at Barclays certainly very much welcome the government's growth review into this space. Barclays has a relationship with around a quarter of the mid-sized businesses in the UK, providing credit, payments and collections and many other financial services. We are delivering on our Merlin lending commitments, as well as making available very significant credit capacity through other products such as invoice financing, supply chain financing, capital markets and many other forms of finance. And as a well-capitalised bank with a broad, diversified business model and with a desire to grow both in the UK and internationally, Barclays is keen and very, very keen to build and strengthen our relationships with UK businesses and corporates. The mid-sized segment is a very broad church, and so when you're faced with the question around what are the issues facing it, you have to ask the extent to which there are genuine common issues being faced by mid-sized businesses. And in my view, which I think is probably somewhat different to Matt, unlike in the SME space where there are many what we as bankers often call lifestyle businesses, the vast majority of mid-sized businesses in my 15-16 years experience working in this field actually are very growth orientated and are often looking to scale up their businesses. Many are going through the transition from owner managed to owner directed, with the consequences in terms of a wider equity base, more product diversity, and an increasing level of operational complexity that they need to manage. So in my view, these businesses will typically invest for growth if they can achieve the following 3 criteria. First, the investment should be justified through future expected profits and future expected cash generation. Second, the risk profile of the investment should be acceptable to the risk takers, and thus the risk capital is available to the business. And third, the investment should be consistent with the values of the owner and the decision makers within the business. Growth can be achieved without investment, but it requires very, very careful financial management. If the rate of growth exceeds the generation of capital, then clearly the company can find itself overtrading. In other words, it's starved of oxygen, and certainly if it has borrowing as a lending bank, that can be a deeply problematic time, and we're faced with making an assessment as to whether it's a liquidity issue or a solvency issue for the business. Possibly like some other people are thinking about Greece at the moment. The decision makers behind this investment decision have to have sufficient confidence that the investment will prove good. And for me, this is all about confidence, and failures of confidence will deter risk takers from making the investments required. So, in my view, we can reframe the whole question and ask ourselves, what are the underlying sources of investment confidence? We recently surveyed the managers of 660 mid-sized UK businesses, and we found that 53% of the respondents believed that real GDP per capita would increase in the UK over the next 10 years. We know that real incomes are falling at the moment as inflation outpaces wage growth. And growth businesses, particularly in the mid-sized space, but this is a generic comment, have to look through the underlying macroeconomic backdrop and spot their own niche and their own profit niche in order to maximise their own opportunities. Perhaps as a consequence, the survey also found that 78% of these businesses, turning over between 20 and 100 million pounds, are expecting to start or increase the level that they export outside the UK. And it's an obvious thing to think, if domestic demand is likely to be weak, then any growth-oriented business is naturally going to explore what new markets it can find for its products. So the government initiatives to broaden the mid-corporate focus of UKTI to help exporters as well as bring inward investment are very much to be welcomed. And I think the closer relationship between the ECGD, Export Credit Guarantee Department, and the UKTI will also be a step in the right direction. Confidence that there will be domestic or export demand for products is crucial. The next question you have to address is access to finance, and obviously, hopefully you were expecting that a banker would at least have a view on this. For me, you can pose it as 2 separate questions. Firstly, is there a problem with the availability of finance, either across the market or in particular subsectors of the market? And secondly, is the cost of finance prohibitively expensive? I think the second question is easier to address than the first, so I'll do it that way round. Interest rates are at all-time lows, and new borrowing by companies, according to the Bank of England, is at an average gross interest rate of around 2.5%. So net of tax, we're talking around about 2% nominal cost of borrowing. In other words, when you adjust for inflation, real corporate borrowing interests are in fact negative. So when businesses choose not to invest when the cost of capital is so low, then either expected demand is very weak, or the firm simply cannot access that finance. So that brings me on to the second question. What are the facts behind the availability of finance? Well, at Barclays, our credit approval rates and underwriting standards have remained broadly consistent for many, many years. Utilisation of credit as a percentage of available lines has remained remarkably steady for the past 7, 8, 9, 10 years, as long as we've tracked it. We want to lend. It's clearly one of our core products. Our view is that fundamentally demand for borrowing is currently very weak, and businesses are looking to manage for cash and defer investment decisions predominantly because of a lack of ability to foresee demand. We then come on to where does the finance come from, and the Minister mentioned opening up the corporate bond market potentially. As bank regulations change, we would expect there will be a substitution effect, making non-bank lending relatively more attractive than it currently is. And therefore, in the future, Barclays would expect a larger proportion of the supply of finance to come from non-bank lending channels. There remain, however, some very significant obstacles to the development of a deeper debt capital market in the UK, specifically around cost of disclosure, transparency, and credit ratings. So, what of this is the territory of government to improve or resolve? Firstly, I think the growth review should certainly consider the role of tax. On the demand side, to what extent are capital allowances aligned optimally with the growth review objectives of supporting the creation of wealth and jobs? On the supply side, what tax incentives exist to incentivise investors in mid-sized businesses, and are they set up to encourage long-term investment and risk sharing in these business propositions? Many business people that I speak to tell me that there is sometimes an investment horizon gap between third-party financial investors and the original owner-managers of businesses. And so potentially tax has a role to play in incentivising and bridging some of that gap, in my view. Second, skills. Growth requires a strong foundation of human capital as much as financial capital. Skills are needed not only amongst the general employees, and many of my clients tell me that there is a big problem in sourcing general employees with a sufficient level of skills they're looking for, but also to echo what the Minister said, amongst the key executives within the business who increasingly need to develop professional management skills in marketing, law, finance, accounting, economics. I think there is some real work to do there. And again, mirroring as the Minister was saying, if we look at the German Mittelstand, which has clearly been a very successful part of driving Germany's strong trade account, the operational effectiveness of German Mittelstand is world class. And for me, I just wonder whether it's a coincidence that 60% of inherited family-owned firms in Germany have outside professional management, and the comparable stat for the UK is 23%. Third and finally, removal of uncertainty around regulatory change. We need to give businesses confidence about the regulatory backdrop so that they can make investment decisions knowing the environment in which they'll be operating and seeking to make a profit. So in conclusion, we very much welcome the growth review. Look forward to the discussion shortly. We think that mid-sized businesses are clearly a key part of the UK economy, and anything we can do to improve that is very much welcome. There are some fantastic businesses and entrepreneurs in this segment of the UK economy, and we at Barclays are very, very proud to bank many of them. So anything we can do to move forward is a positive step. Thanks.
Thanks, Dan. One of Dan's kind of key points here was that there's money available out there and that people just aren't spending it or aren't taking on the borrowing that they might otherwise do. And I've got to confess now to have seen John earlier today, so I might have a bit of foresight of what he's going to say. But I know that British Chamber of Commerce have published a report that's showing that sentiment's positive amongst firms still. So I wonder whether you have any ideas about how we can get people borrowing, investing, and that sort of idea.
Okay. Well, I better stand up as well, hadn't I? Right, so like the old man over here. Can you just tell, just a quick show of hands, how many of you actually are in a middle-sized business? You consider yourself to be middle-sized firm? And how many of you advise those sorts of businesses? So in fact, the audience is packed with people who know better than we do what it's all about. So one of the things I won't do is spend too much time talking, because it'd be much better to have a discussion, and I think it's much more interesting for you and me not to listen to me for too long. I actually went to a breakfast meeting with an ex-head of a supermarket chain, come politician and now in the media industry, who shall remain nameless, who started by saying that and then proceeded to speak for 50 minutes. So you can guarantee I won't do that. Yeah, well, I've got a bit of laryngitis. Anybody who saw me this morning will know that, so apologies. And I also was told this morning at the session I was at that it was actually political suicide to defend the banks. Fortunately, I'm not a politician, and so therefore I'm well placed to do that. And I did actually say this morning that I thought the banks were in a very difficult position because they're being faced with a requirement to rebuild capital and build it even further against the possibility of further bank collapse elsewhere, but at the same time being hectored to lend to businesses. However, which actually then, in a sense, puts the onus firmly and squarely on government and the Bank of England to resolve that problem in relation to access to capital, either via the banks or without the banks. So that's, I guess, the sound bite on that particular issue. But I'll now go on to talk a little bit about medium-sized businesses, having answered that question. And I have just really a series of observations, and then I think we can get into a question and answer session. And first of all, just to say that the Chamber network, the British Chambers network, have over 104,000 businesses within the network. And many of those businesses are small or medium-sized. So most of the medium-sized businesses, or very many of them in the UK, will actually be in the Chamber network. A lot of those businesses export. In our Q3 survey, which we published last week, I think, it seems like a long time ago now, I think it was last week, showed that actually manufacturing businesses are still predominantly confident about their trading at the moment, that manufacturing exporters are predominantly confident about their trading, and that to a lesser extent service sector businesses in export manufacturing in export are also pretty confident, but they all have a concern about working capital and cash flow. It's a huge issue, and it was referred to a moment ago about starving the oxygen for growth, because as we all know, it's when companies are actually expanding that they die as a consequence of inability to fund that expansion. So if we're actually going to have an expanding UK economy in the middle-sized sector and in the small sector, it's hugely important that there is actually enough air cover for that expansion to take place, or it will be choked off. So it is a really important issue, that. I guess that the challenges for middle-sized companies generally are the same challenges for the UK economy as a whole, and that's been well discussed, and there's been a lot of discussion around those issues. And for exports, certainly they are the things that have also been well documented: regulation, distribution channels, credit risk, information, and access to capital we've just mentioned. One of the things that a lot of our members tell us is that actually one of the very important factors in being able to successfully get into an overseas market is actually having access to contacts and networks to actually be able to develop that business. And the fact that advisors are setting up around the world is a very important positive, I think, for medium-sized businesses, because they will be able to help medium-sized businesses, those sorts of businesses will have the full suite of advisors, be able to help them to access those markets. The Chamber network also, of course, provides a useful channel for this, because we have extensive contacts with chambers overseas and British chambers overseas, and also contacts with other channels of accessing markets. And the various regional chambers really focus on the businesses that are in their regions, so they'll specialise in particular types of industries or particular types of markets. I was also speaking only just before coming here about the whole business of actually access to physical transfer to markets in a BBC radio interview, which was really around the issue of airports. So I know it's a sort of tangential issue, but it's hugely important, even in this day and age with the internet, that we can actually physically turn up in country and see people and create networks and build relationships. And I've actually done business myself on every continent in the world apart from Antarctica, and I know very well that you cannot do business in many places in the world without that personal relationship and contact and networks. And the longer we've gone in the UK, not providing proper air access to markets that we might want to explore, the worse it will get. Our surveys show that markets that have direct connections with the UK through Heathrow, businesses do 20 times as much business with as those for which we do not have direct access. So it's one of those issues that, you know, if we're going to promote trade, we have to look across the entire spectrum of what it is that promotes trade, and that needs to be addressed and facilitated. I guess the only other thing I would mention very briefly is management capability, and clearly the best sort of support that managers can receive, and I'm speaking also from personal experience, in relation to upskilling, particularly for export, is actually mentoring and networking. It's even more important than, you know, professional qualifications in management and so on. So the more we can actually build mentoring groups and networking groups, where people who want to export or are entering new markets or developing into new areas are able to talk to people who've actually done it in practice, the better. So I'll end there, and I think we'll have a very good discussion.
Thank you, John. We have 17 minutes of the Minister's time, so I'm going to not take the Chair's prerogative and open up the question of my own, which I have many of, but I want to hand over the floor to the experts. I wonder if you had any questions. If you could say who you are and where you're from, it would be really helpful. Or do I have to take Chair's prerogative?
Yeah.
Oh no, here's one.
Mark Prisk from the CAW. Minister, I wonder, if I could ask two questions. Firstly, is the autumn statement and the growth review, will it all be over for the focus on end businesses after that is announced, or do we expect to see a continuing initiative around end businesses? And the second question is, to what extent, when considering what you might do for end businesses, do you feel constrained by EU state aid rules?
Interesting. Yes, two questions for the price of one, and I would expect nothing other than Clive for you to squeeze us in. No, the way I would see it is that once we have published a growth review, in my book, the real work begins, in that sense. And this is the point about this. It's a cultural change that I think some parts of Whitehall haven't necessarily grasped in their entirety, and possibly some ministers haven't. So no, my view is, once we have a plan of action, then we've got to make it work, and that's absolutely crucial. And in terms of state aid, no, I mean, I think, again, all things that government does have to comply, and that's the nature of the beast. We've been able to go through the EIS changes, for example, sort those out, got the state aid clearance, get on and reform it, and do it. It's frustrating. I would like to move more quickly, but there are rules, and we've seen other countries where perhaps the danger of the past has been the rules haven't been applied to, so we need to make sure that we're operating in an effective, genuine single market.
Dan, you were saying about confidence and regulatory burdens. I wonder whether you had any views there about the balance, what comes for small businesses from Europe as opposed to the UK, and whether you've seen any change in that, or whether that is a barrier to the businesses that come to you.
Yeah, I mean, I think for the business I speak to, the real issue is, as I mentioned, it's uncertainty, particularly when you're looking at investment decisions. If we're talking about growth, it's businesses trying to plan, and therefore if they don't feel able to plan because they don't know what the environment's going to be, then that can be an issue. Yeah, you meet many business people who aren't big fans of EU regulation, that's for sure, but I'm not sure I've got any real empirical evidence that it's that or another thing. The one thing that probably comes up more than anything else is probably more about planning laws. And planning laws are certainly often talked about with my clients, and around that being a real issue to them investing in their business.
Is that a similar story on your part?
Yeah, I think so. I mean, I've already mentioned a certain type of infrastructure and the need for a predisposition towards saying yes in planning rather than no for business development. And the recent debate on the change in the planning rules, was edifying in the sense that it seemed to boil down to whether we were going to tarmac over Downton Abbey rather than actually provide a facility for businesses to expand into the next brownfield site.
Is there a question just there?
Yeah, Richard Brooke, early stage venture capital company, Synergy Limited, amongst other things. You mentioned risk profiles. and I'm keen to get some opinions on how much a difficulty in matching risk profiles between people seeking finance and the providers of finance is a problem. And I believe that, I mean, we talk to a lot of small companies who are looking for bank lending, but in fact maybe the security that the bank wants is beyond what they're prepared to risk. And therefore I think a mismatching of risk profiles is one of the barriers to accessing appropriate finance. What do you think we can do to improve that situation?
Let's turn up first. Do you want me to? Yeah.
We'll let the bank go first,
Yeah.
Mark come in second, if I may.
So, I mean, in venture capital, for me, it's generally relatively small businesses that are looking at fast growth. So there, the role of collateral is important, and particularly it's as a lender where you're looking to lend against proven cash flows. By definition, a venture capital proposition is not that, and therefore to lend to it, you need to have some alternative source of repayment. So in that space, things like the Enterprise Finance Guarantee Scheme are very useful. That, I think, is a product, a solution that could be improved. In the mid-sized space, I think it's slightly different because most mid-sized businesses at least have some form of cash flow track record to look to. And businesses generally there have a trading performance, and they can borrow against that. But yeah, I mean, clearly there are many times when I, as a lender, I'm looking at a proposition thinking, I love the business idea, but it's an equity risk in the sense that it's an entrepreneurial decision about a bit of growth that is not proven, and that's not a bank lending risk. That's an equity risk. And I think the Minister mentioned, one of the key things is to make sure that the supply of equity is available for those kinds of risks, and I think there is potentially work to do in that space.
At the risk of ruining your 9 words, what can actually government do in this space?
I think we have to be quite careful here, not least because government needs to avoid actually starting to lend your money on the basis of its own judgment, which is, I think, dangerous. I mean, I've been happy for us to advance and expand the capital enterprise funds because they're on a pari passu basis, and that's fine because we're working on the basis that by working alongside those who have skin in the game, they're far more likely, not guaranteed, but they're far more likely to make that judgment on the basis of good knowledge because they have something to lose themselves. Right? So that's a principle I'm comfortable with. Government investing directly without using that expertise is, I think, a big problem. I think EFG was a good idea for the small businesses where there's a lack of security, but I think there is a problem, and this is something where the credit easing discussion that's taking place may well be as much about mid-size as perhaps small.
Yeah, I mean, a few thoughts, I guess. I mean, first of all, one of my concerns is that the whole of the UK perspective, government, business, and the banks have gone from what is a highly risky economic model to a highly risk-averse economic model, and there needs to be some rebalancing of that. And one of the things about the Vickers report that concerned me was that actually that may have actually gone too far when our key objective at the moment is to actually get growth back into the economy. And that's otherwise we'll end up in a worse position than taking the risk of not having the security of that extra ring fencing security that Vickers incorporated into the proposal. So that's the sort of macro point. For owners of businesses, the risk-reward ratio is really important. And if we're actually going to encourage businesses to expand and to take the risk also of going overseas, the reward has to be sufficient. Of course, that reward isn't always purely financial. It can be all sorts of different things that motivate entrepreneurs and owners and shareholders to, well, entrepreneurs and owners to do things. Shareholders are slightly different. So, that does need to be looked at. I struggle with the whole issue of that actually anything that a business does that carries any entrepreneurial risk is not a matter for the banks and is something that has to be dealt with by equity. I really worry about that as a philosophy, Back in comparison with what happens in Germany, for example, which we've mentioned a number of times already. Because, for example, if you're a medium-sized business and you're expanding quite rapidly and your big issue is working capital, what you need is access to bank finance or similar to carry you through the period of expansion. You're not going on the risk-reward ratio to give away a huge chunk of capital, to give away a huge chunk of equity, should I say, to some third party. Why would you do that? You're better off just sticking to your guns and keeping on with the business. As somebody who is actually an entrepreneur myself, who established a business 2 years ago, I speak with some feeling. It's exactly what we would do. The Enterprise Finance Guarantee Scheme is an interesting proposition in the sense that the people who actually are shareholders had some skin in the game, but weren't put in a position of having to carry the whole of the risk. However, the way it actually operated in practice, as far as I could see, is that there needs to be double indemnity, that actually the guarantees put up by the entrepreneurs were actually the full guarantee, in addition to the government guarantee as well. And I actually think that is that if that's how the scheme is meant to operate, which I've been told by some that it was, but other banks actually didn't operate it in that way, then I actually think that's a real issue, because it didn't really fulfil its purpose of de-risking. The business growth fund, is it that phrase?
Yep.
That the banks have set up is a good thing, and I think it's to be applauded, and actually will also impact to some degree on mid-sized companies as well as the small, potentially. The real issue for that for me is how greedy it's going to be, because actually if it's excessively greedy it simply won't work, because it's unreasonable to take a huge chunk of equity in excess of what would normally even generously be expected in these straitened times. So the real test of that will be how that fund's operated. I guess the final thing I would say is that it's not always clear, of course, as was said earlier, what a middle-sized business is, and often it depends on which sector you're operating in and where the big step changes have to take place. So it can, for example, the step between 8 million turnover and 15 million is often a huge leap that actually a lot of businesses never take because they don't want to take the risk. The next sort of step after that could all depend on the scale and nature of the market. So you can actually, in a sense, have it be a medium-sized business that's very small, or a medium-sized business that's very big in terms of turnover. It's more of a thinking style that defines it for me. And I think when we're looking at access to capital, that has to be recognised as well. Some markets are quite niche, you may be quite small, but actually you're a medium-sized player in that market. And there's substantial opportunities for generating wealth for the country and for generating exports. Long answer, sorry.
Any more questions? Might take both these questions here and perhaps ask. You go first.
Sam Cook from the City of London Corporation. I was interested to hear the Minister mention a move from bank finance to equity finance. This is something we've published a couple of pieces on research on now. But one speaks to sources of finance, and I'm afraid I'm no expert on the details. But one of the things they say is that they face what appear to them to be excessive regulatory penalties for investing at the smaller end of the scale, for instance in AIM stocks, because they're deemed to be too risky. So I wonder whether this is something that the panel has encountered ever, and whether it might be worth looking at as a sort of form of light or equity easing.
And the second question?
I'm Dave McLean. I run a medium-sized publishing company in Birmingham. This chasm between equity and debt finance goes to the heart of the problem to me, which is that the problem with equity from the point of view of people in my position isn't just that it comes in different terms, it's a fundamentally different thing. It's the beginning of an exit. So the way it works in the UK is, in my limited experience, as soon as you're involved with equity, you're committed to an exit. So you can never become a Mittelstand company if you take equity on. So therefore, all you can do is grow your business organically through your retained earnings or your capacity to raise bank debt. There's just this giant chasm. The reason we don't have middle-size, globally dominant companies and long-term private ownership is because I cannot see how, in the funding model we have in the UK, how you get there. I'm condemned to grow on my ability to finance the business from retained earnings unless I bring some equity in. If I bring some equity in, I'm no longer a privately held company. It's going to end.
Two questions on financing. So I want to get one final one in.
Tom Holmes, picking up on Tom Holmes from Vertex, picking up on Clyde's question earlier about EU regulations, I've got a very specific question, which is that most of the business I do is in the public sector, and on a number of the bids which I would like to be bidding for, companies with a turnover level of less than 500 million are specifically excluded. Even when actually the nature of the work, if I give a specific example, a southeast local authority with a relatively small piece of work intended for gave an equity level of 500 million, by definition that excludes medium-sized enterprises and certainly excludes small enterprises. And I don't see that as a description of the desire of government to trade and expand medium-sized enterprises. So
Three great questions. Let me hand over to you
Yes,
in the 2 minutes you have left.
Yeah, indeed. I get contrary arguments around the AIM issue from different people, partly depending on who they are, of course. I think there is a question there, but in a sense it almost leads me on to your point, which is the nature of what handing over equity involves, partly the way in which company law and governance and so on and so forth operate, and the equity markets operate. And I think this is one of the pinch points I feel we've got to get under. We've been getting some quite good evidence in this area, but I agree with you. I think this is one of those areas where the gap is pretty wide. It's wide. There's a cultural issue here, I think. The fact that we have a remarkably successful financial services sector. It's a very different one. It's concentrated, whereas in Germany it's very much a regional banking system. There's a different culture in the financial sector, as it were, but there's also a different set of governance and company law. So I think this is one of the things that we want to address. On the last point, I share your frustration about this. We've started by trying to strip out from central government some of the nonsense around particularly pre-qualification processes. That you must have 3 years of fully audited accounts before you can even pre-qualify. That you must fill in endless duplicated questions that are identical from one area to the next. We're publishing publishing contracts now increasingly online. We want to make sure that we remove duplicated pre-qualification processes, and we're also looking to remove some of these rules when, in many cases, what should be, in terms of any financial capability, it should be in the contract, not in the pre-qualification process.
Absolutely.
That's where it should be. Getting our dear friends in local government, and indeed some of the other delegated parts of local government, i.e. health trusts and so on, to change that culture as well is our next group to sort of deal with. And it is not easy, but the last 16 months, Francis Moore and I have been banging our heads against various parts of Whitehall to try and change this culture. So we start to open up these contracts, because I agree with you. I think the moment you start setting sizes of who can bid, well, surprise, surprise, you probably end up with 2 people, maybe 3. So I think we can see that. So that's something that Francis and I are very alert to. Getting the change of culture to be as quick as you and I would like it to be. I suspect I may be slightly disappointed, but we're on the case and very happy to receive examples.
Well, there's very little appeal process, so effectively we would feel that if we appeal against those specific points, we almost become disqualified then from the competition which might ensue. So if there were an alternative route to appeal and more, and to comment upon procurement pieces, I think that would be an interesting change to bring about. I think also that the procurement advisors, so the organisations who advise on government procurement, can also play a role in this. And currently they do play a certain role, but it may be not always aligned with government thought and desire.
Indeed. I can think of several examples I won't go into now, but yes, we're alert to some of it, but the more examples the better from my point of view. Thank you.
I'm conscious of your time.
Yes, would you mind if I
Absolutely.
drift away?
Look, thank you very much
skip
for
away.
coming and speaking with us. And best of luck for the rest of the growth review.
Thank you. Thank you very much for your questions.
Hopefully, we still have some time left, so if anybody wants to take advantage of the huge expertise we have.
Can I just comment on the investment, this point around at the exit?
Yeah.
And I tried to refer to it in the tax point I was making about investment horizons, because I think it's an absolutely key point. Where pretty much all of the equity investment that is available in the UK is looking for an exit, and in fact the Business Growth Fund is no
In 3
different.
to 5 years, moreover.
Yeah.
And what good things happen in 3 years in the real world?
And the Business Growth Fund, which has closed its first transaction a couple of weeks ago, so it's great it's up and running, and it will certainly play a role in providing a new form of equity or a new source of equity in the market. But it's no different, so it also has exit horizons that it's looking to achieve, and I think for me, what conceptually exists to try and bridge that gap. Tax is one thing that actually can change investment decisions. So if there are tax benefits to holding investments for significantly longer periods of time, then it potentially has the opportunity, in my view, to just to lengthen those investment horizons.
And this is one area I quite fancy picking up with you as well, actually, because you're arguing for kind of longer term, greater certainty over regulation, but then also making points around changes to taxation, perhaps changing capital allowances, and having worked at the Treasury, you know that if you change capital allowances, you'll just take it back somewhere else from corporates, and so you're paying the same amount of net tax anyway. So would it not be better actually if you just say certainty around everything and stop doing anything?
You have spotted the self-contradiction in what I was saying. Yeah, I mean it's a balance, isn't it, between keeping it stable and getting the incentives ultimately right. And yeah, I confess that it's not a straightforward thing to get the balance between those two things.
Any thoughts on any of those 3 questions, or more widely?
No, I mean, I think I've sort of said what I had to say on this. It is around risk reward for the individuals, longevity of access to capital, and the whole ethos in the UK of risk versus risk averseness. And the banks are sat in the middle of it. The Bank of England and the government have got to do something about it.
Any other questions? We'll take probably 3 again here. Go that way.
Can I ask you? I'm going to ask 2 questions. First is a direct follow-up to the one we've just dealt with, which is around.
Could you just say who you are?
Sorry, I'm John Dodds. I'm the Director of Innovation at the Department for Business Innovation and Skills. So I'm interested in this point about why specifically equity investors are looking for an early exit, and what it is that disincentivises them from investing for the long term. And I'd be interested in your views about whether it is actually being driven by the fact that there is a distortion between the way that effectively dividends are taxed and the way that capital gains is taxed, or actually whether even if we had a level playing field there is something kind of cultural that's behind this that we need to address. Second question is something that I've picked up very directly from businesses. I've been going around talking to them about my innovation brief, and what they say to me is that something they feel very frustrated about is that the banks they go to for lending seem to have a time horizon of about 2 years, and they will be prepared to advance a line of credit for basically 2 years, and after that the whole thing is up for renegotiation. Whereas in Germany it is alleged banks will lend over a longer time horizon, sort of 5 to 6 years, which gives them more certainty in terms of their investment plans. Now, I don't know whether that is complete tosh or not, but I'd be interested in a kind of a view from people who've had experience around whether there's something in that.
And gentlemen, you've already had one.
I've already had one. Yeah.
I'm going to pop along to the ladies here.
Mine's mostly directed at Mr. Longworth. My name is Tara Coffey from Kilburn Knowlton. The M Institute, in a report that they did, said that I think it's 68% of businesses said that their ability to succeed is dependent on management and leadership skills. And Mr. Longworth, you underlined that mentoring and less professional qualifications are key. It'd be interesting to hear, given your experience as a businessman and in comparison to the Mittelstand, what a good structure might look like in terms of those less tangible skills and sharing between mid-sized businesses.
I'll let you answer first and then let you answer the
Okay.
whole.
Well, taking that point, clearly, one of the things that was said, I think, earlier in this session is that there's a much higher proportion of businesses in Germany have professional management, and if they're family-owned businesses than in the UK. Of course, family-owned businesses is only one part of the equation for mid-sized businesses. The one thing, I think we might, businesses have to go through growth phases, so actually getting over those hurdles is really important, and having professional help to do that is quite important, and advisors play a key role in that area. When a business has been successful, we have to recognise the fact that the management in that business have done a good job, even if they're owner managers. So it may simply be that they have reached the boundaries of what they know for expansion and need to know some more in order to actually go into new markets or new areas of activity. And one of the best ways to learn those things is from other businesses or business people or advisors that have actually been there. So it's not necessarily the case that the owner managers haven't got the management skills, because they've actually created a business and grown it already. So it may simply be that they need additional knowledge and information to operate in new uncharted territory. One of the things that, just referring to chambers again, one of the things that Chambers of Commerce try to do is to provide mentoring networks for businesses, particularly in export, for example. And there's a lot of work going on in the chamber network, both regionally but also nationally, with with link, for example, the China-UK link, which is just really beginning to start delivering some tangible stuff in terms of bringing together Chinese businesses with UK businesses so they can do business. And there's no substitute, having done it myself in Asia, for example, with actually talking to people in country and understanding how that market operates. So it's not all about somebody going off to Harvard and getting an MBA. It's actually very much about actually the businessman understanding what the market is and getting the contacts and networks and partners to enable them to do business. I mean, historically, most business was done through, initially, partners in country. It's only later that actually, during the process of entering the market, that then the business has the capability and knowledge to set up completely independently. And that's been like that for centuries, hasn't it? And as I said, earlier today in another place, I find it quite remarkable, really, that 200 years ago, when we were blown around by the wind in sailing ships, Britain traded the entire world, in particular Asia and South America. And in the age of a internet superhighway, we seem to find it difficult to look beyond Europe. It's just, it's unbelievable that we've actually got ourselves into this position. And we need to reorientate ourselves in the UK, both government and business, to a different world market. I see that that's actually happening. And when I go around the country, I've only actually been in this role for 5 weeks, so you'll have to forgive me a little bit. But I have been to 8 regions already and seen umpteen businesses around the country in those chamber regions. And there's some fantastically exciting businesses around the country who have the skills, the knowledge, the energy, to some extent the resources, certainly human capital, to really do a fantastic job and are growing rapidly. And they just need, excuse the pun, a fair wind and a good environment for business growth. And that, again, is something that has to come from, to a large extent, because these are things that, whether it's market failure, in the sense that markets can't provide it, from government and from the financial structure.
Can I leave you to answer the really tough question?
There were two tough questions.
There were two tough questions.
But can
I'm
I'm going to make
absolutely.
I'm just going to make I guess a personal observation on that. I agree with John that it's it's not all about going to Harvard and getting an MBA. I in fact went to Chicago to get my MBA. Just a personal observation from that. In my cohort, I've got many friends who run Mittelstand businesses in Germany, who run mid-sized businesses in the US, in India, who were peers of mine when I did my MBA. All the Brits on the course were in the financial services sector. So just culturally, it's very interesting that actually there is a difference in terms of culture around people looking to build those professional management skills through MBA. And judge what you want about whether an MBA gives you something. It does tell you something about the culture.
Well, it wasn't personal.
So the difficult question. So why is an investment horizon shorter, or what drives that? It's probably to do with carry. So most of the equity that comes from third-party investment is obviously managed by equity investors, and I think you have to look at how are they incentivized, and their incentives are strongly, I wouldn't say necessarily myopic, but they're certainly medium term. They need to churn their capital in order to achieve their targets and their personal growth rate. So I think it's predominantly about the individuals who are working for the equity investors and how their incentives are structured. I've no idea what you do about that, but that I think is what drives the desire to exit. The second question was around the 2-year loan point. So, yeah, I'm a little bit surprised by that. So I think John was, I mentioned the oxygen cash is the oxygen of the business, and John picked up on that in terms of the need for working capital, and growth businesses have a need for working capital, and that by definition is self-liquidating. It's very short-term in nature. And businesses do need access to that. And I think we'll have a difference of opinion in terms of whether that's available or not. But there are improving techniques actually out there around things like supply chain finance, which allow the risk management of that working capital cycle to be better, which allows finance providers to take more comfort that actually what their funding is going to liquidate and make sense. I don't see there's a problem with two-year money. I mean, the vast majority of what we lend, and we lend ultimately, somewhere around 20% of the total lending into UK businesses, it's either short-term because it's working capital, or it's generally 3-5 year money for larger corporates where we're lending against their ability to run cash flow, or it's a much longer term on a commercial mortgage basis for generally for smaller corporates. So I don't think there's an issue with 2-year money. It's typically 3, 4, 5 year money. Some businesses get 6-7 year money. What's interesting though is with some of the regulatory change around things like Basel III and the introduction of the concept of net stable funding ratio under Basel III, which is a new ratio that banks will have to adhere to. The ability for banks to do what's known as maturity transformation, which is to take short-term deposits from all of us as bank depositors and turn them into long-term assets, that's somewhat reduced. And so one of the consequences potentially of that is that actually banks will look to shorten the duration of their asset side of the balance sheet over a period of time. Now those ratios don't come in for, I can't remember, up to 2019, I can't remember exactly when they come in, but structurally it's something we need to be alert to in terms of whether that causes issues.
I think we've got time for a couple more questions. There's a one there.
So my name's Andrew Warren, and I work for Vertex, and I'm an owner-manager. It's a private equity-backed business, so we could talk about that later, but that's a different thing. I guess for me, I'm quite worried what I hear about that government's decided that we're all going to become Mittelstand businesses. And I have the misfortune or good fortune to have bought a couple of Mittelstand businesses. In fact, he and I worked with one for some. And I have to tell you that my experience of them, which is limited, but Laura, is that they sell when the owners realise that actually they need their retirement fund, and the professional management that's much lauded about typically gets brought in 18 months before to tart it up for sale. So I'm not sure the reality is quite. And of course, Mittelstand businesses, certainly the ones that I dealt with quite a lot, were incredibly myopic about what they wanted to do. They were world class in Sindelfingen. And if you've ever been to Sindelfingen, you'll know what that means. There was no aspiration, and the divide between big German corporations was quite easy. So the fact that government is here to help us to understand that we need to become Mittelstand businesses, and it's going to innovate for us to help us do it, I'm now really worried. And if I could sell and the taxes weren't so high, I'd be a tax exile.
That's a good one. Mittelstand bad, UK firms good, I think I'd take from that.
No, I'm just saying Mittelstand is not the answer.
Thoughts? Briefly?
Yeah, I mean, I agree. You wouldn't want to just, it's not a cut and paste thing.
It just feels that way.
There are, but I do think that if you look at the structural issues in business overall, where is the government looking for GDP growth to come from? Investment and exports predominantly, because it's unlikely to come from consumers, and it's certainly not coming from government spending over the next few years. And when you look around the world, the German Mittelstand have been world class at that high value added capital goods export market, and have really built a very successful business model, which has been a big part of the success of the German economy. So I agree we want to take all of it, but I think that it is a model you need to look to and try and understand what it is that they have got right.
I'm going to be really rude in the absence of the Minister. I can see a hand up from Biz at the back, so perhaps you can defend.
Yeah, I think just a word of reassurance. I'm Chris Sadler from the mid-sized business growth team of Biz. I think we recognise absolutely the Mittelstand is not necessarily a comparable group with the group of UK firms we're looking at, for one. And two, we also recognise the UK is largely just as good as, if not better in some areas, as anyone else in the world. We just recognise that the German Mittelstand is a world-class group of firms, so it's worth looking at for that purpose alone. Just like we would look anywhere else around the world at any other world-class group of firms. But it's not to say the Mittelstand is, far ahead of better than UK firms. So a word of reassurance there. We accept.
I'm always reassured when I hear from the States.
Any final questions before we wrap up? Oh, one just there.
Kristen Zentaba. I was just wondering, just general comments about a lot of the companies which are medium-sized that are based heavily in innovation on what would be based in products in future markets, not necessarily markets today, are finding more difficulty finding investment today, obviously because it's a higher risk, and having more difficulty demonstrating, of course, that it is a managed risk because there will be a future market for whatever said product. So I just wanted to get some feedback on what you think should be out there in terms of both government support and also financial support for those types of businesses.
John?
I sort of always hesitate really to take any particular type of business. I had a similar question earlier today about creative industries. One of the things I always start off by saying is all businesses are good businesses if they create wealth, pay taxes and abide by the law. I think somebody quoted me on that recently and disagreed with it, but then the Financial Times is not really a free market paper, is it? Secondly, what governments can do is macro, really, and they should really stick to the knitting and actually do macro and not try and intervene in a micro fashion, because they can create an environment, so we have an infrastructure in the UK that works and facilitate, because markets can't provide that, although of course we could help, toll roads, building airports. They should create a financial environment and a risk-reward environment that includes the tax system that actually creates the environment for economic growth. And if you look long term, across the world, the other history there, but if you look long term across the world, and you look at countries that have developed and haven't, why didn't China develop very much for nearly 1,000 years? whereas actually Western Europe developed to be world leaders. And it's all about creating an environment where individuals are rewarded for taking the risk and busting the gut. And it actually, if that environment's created, the government doesn't have to do anything, just stand back and watch it. It will go. And the UK have done it many times before and can do it in the future. So that's what I would say, even whether it's tech businesses or not. And the final word, I guess, is that I also think big businesses actually have a huge responsibility also to help facilitate the growth of medium-sized and small businesses, because often those businesses are in their supply chains, and actually, taking them with them as they go overseas works really well where it has worked and could be done a lot more.
I'll take one final question from the gentleman just there.
It sort of picks up on the taxation. Chatting to some business people.
Sorry, can you just say who you are?
Oh, sorry, yeah, Harry Muller, the City UK. Chatting to some business people, stroke entrepreneurs, and they're probably actually in the small space, but they're talking about moving up from small. And they talk to me about the tax structure where the investor goes in with tax exemptions, like EIS type situations, in a good tax environment. The founder has a beneficial CGT environment, but when the business person looks to grow the business and they try and take their former colleagues from a blue chip organisation with 6 big salaried people and all the benefits that go with that kind of blue chip organisation to a significantly reduced salary, but without those tax benefits, they become subject to the kind of general employee tax environment, but they're effectively being a kind of living investor, almost a semi-founder in an organisation. And that creates real barriers, bringing the people from the bigger organisations to the smaller ones to grow the small ones. Just something that I've been told by entrepreneurs.
Perhaps I can hand over to our two remaining panellists to both answer that, respond to that point, and also perhaps give us, rather cheekily, one thing you'd like to see in the autumn statement as a conclusion from the mid-cap growth review.
Okay, to be honest, I've not come across that particular point before, so it's not something I picked up. It's an issue certainly worth investigating, but it's that's a new one on me. I think we've talked about management skills a lot, and we've had a bit of a discussion around the comparison with Mittelstand, and that's the last time I'll mention German mid-sized companies. We haven't really developed the thought process around just general employee skills, and actually I think that's at the root of so much of it. So for me, if the growth review can look at things that government, and this is certainly within the domain of government, but things the government can do to really address the basic skills gap in the economy overall, I think that's very welcome.
Make sure that credit easing and quantitative easing, if possible, enters the real economy.
That's a whole on that whole new subject of nightmarish complexity. I might close it down.
Maybe they'll tell us what credit easing actually is.
Yeah, indeed. I mean, I think it's been a really interesting conversation. I don't want to try and summarise it, because frankly it's ranged too far and to too many very complex tax issues, which I need to obviously brush up on. A couple of things I'd like to take away is kind of the Minister's nine words, which I think any government would quite rightly stick to, that probably less government in this sort of areas, potentially good government. I'd like to pick up the kind of stability thing, which has been a theme certainly, and it will be a continuing theme on the policy exchange side, both on regulation and on tax in everything we do. And perhaps a plea there at the end to join up the mid-sized firms angle of the growth review with the skills angle, because I know there's a separate strand on skills as well, so perhaps it's a bit of cross-government working, which I know the government's exceptional at. So that leads me to leave you with a horrendous plug that this is indeed the first of these events. Tomorrow night we have Andrew Sentence doing a keynote speech with us. That's at Policy Exchange around the same time. Monday is Innovation to Commercialisation with Ian Graven, Technology Strategy Board, amongst others. Next Wednesday at lunchtime is Vince Cable doing a keynote speech on rebalancing the economy. And then next Thursday is a debate on the Eurozone crisis, again in the evening. So it's a busy week or two for us. So interested in any of those events or future events, do get in touch with us if we don't know you already. Otherwise, hopefully you'd have already received those invitations. And just leaves me to thank you all for coming. Thank Allswang and Barclays for putting us up and for sponsoring and speaking. And to thank our panellists. Thank you.